In this example, we are looking at the distribution of income in a partnership. We have Michael Bloom and Richard Tucker who agreed to form a partnership. Bloom contributed $200,000 in cash and Tucker contributed assets with a fair market value of $400,000. The partnership in its initial year reported net income of $120,000. We are to calculate the distribution of the first year's income to the partners under each of the following conditions. So for number one, we are to do or calculate for Bloom and Tucker if they failed to include stated ratios in the partnership agreement. So whenever a partnership agreement does not say how income and losses should be shared, we assume that they will be shared at a ratio of 50-50, half and half. So in this example, Bloom will get to claim half of the net income, half of $120,000 is $60,000, and Tucker will get to claim the other half, $60,000. So partners share income and losses equally when the agreement does not state how distribution should be shared. In example 2, Bloom and Tucker agreed to share income and losses in a 3-to-2 ratio. So the first thing we must take into consideration that a 3-to-2 ratio means 3/5 and 2/5, because 3 plus 2 is 5. So one gets 3/5 and the other is 2/5. So Bloom, since his name is stated first in the 3-to-2 ratio, he is the 3/5. So he will claim 3/5 of the $120,000 net income, which is $72,000. And Tucker will claim 2/5 of the net income of $48,000. In example 3, Bloom and Tucker agree to share income and losses in the ratio of their original investments. So for this one, we have to calculate what their ratio is based on their original investments. Bloom invested cash in the amount of $200,000 and Tucker contributed assets with a fair market value of $400,000. So together, the total amount invested was $600,000. So that means Bloom invested 2 divided by 6, where Tucker invested 4 divided by 6. So Bloom's ratio is going to be 1/3, whereas Tucker's ratio is going to be 2/3. So Bloom will claim 1/3 of the $120,000 income, which is $40,000, and Tucker will claim 2/3, which is $80,000. In scenario 4, Bloom and Tucker agreed to share income and losses by allowing 10% interest on an original investment and sharing any remainder equally. So what that means is we're going to distribute the income based on them receiving 10% interest of their original investment. So what that means is that Bloom invested $200,000, so 10% of $200,000 is $20,000, and Tucker will get 10% of his $400,000, which is $40,000. So by giving Bloom $20,000 of the net income and Tucker $40,000 of the net income based on the 10% of their original investments, we have already accounted for $60,000 of the $120,000 market value. So that means that there is $60,000 left. So after we distribute the income based on the 10%, we share the remainder equally. So they will each get half of the $60,000, so that would be $30,000 to each of them, which gives Bloom a total of $50,000 and Tucker a total of $70,000, which ends up being the total distribution of our $120,000 in net income.